everybody. Welcome to today's webinar. It is Listening to the Heartbeat of the Economy. We're very happy to present different topics and educational presentations and have different points of view and different presenters give us different aspects of the market here. I'm going to introduce Tawni in a moment, but we will first just have a quick disclosure for our compliance aspects. Please note this presentation is for informational purposes only. Nothing presented today should be construed as investment advice or recommendation to buy, sell, or hold any security contract. Since we don't know everyone's investment objectives or risk tolerance, we're not endorsing any specific trading strategies. Security derivative futures trading involves substantial risk of loss and is not suitable for all investors. Each investor must consider whether this is a suitable investment, since you may lose all or more of your initial investment. Past performance is not indicative of future results. Lightspeed is a division of Lion Brokerage LLC. Lion Brokerage LLC is not affiliated with these third-party market commentator, educators, or service providers. Data, information, and material, the content are provided for informational, educational purposes only. This content neither is nor should be construed as any offer, solicitation, or recommendation to buy or sell any securities or contracts. Any investment decisions made by the user through the use of such content is solely based on the user's independent analysis, taking into consideration your financial circumstances, investment objectives, and risk tolerance. Lion Brokerage does not endorse, offer, nor recommend any of the services or commentary provided by any of the market commentators, educators, or service providers. Any information used to execute any trading strategies are solely based on the independent analysis of the user. Thank you. We're happy to have Tawni Ferrarini. She is the Robert W. Plaster Professor of Economic Education at Lindenwood University in St. Charles, Missouri. She was the 2015 president of the National Association of Economic Educators and recipient of numerous awards, including the 2009 National Association of Economic Educators Technology Award. Publishes in a variety of journals, written curriculum materials for the Council of Economic Education and Fraser Institute. She was instrumental in helping formally establish the Council on Economic Education Japan and has been a consultant for the Korea Development Institute in Seoul. Along with her other authors of the book, Professor Ferrarini is the co-author of Economic Episodes in American Economic History. Additionally, she's helped write Common Sense Economics, which has been translated to more than 6 other languages. She's earned her doctorate in economics from Washington University, where she's economic history under the 1993 Nobel laureate Douglas North. We're very happy to have her here, help give some insight on the markets and the economy, and I hope everyone's as interested to hear what she has to say. So we're very excited to get started. Just quickly here for more information on a demo, open an account for Lightspeed. My name is Rob Lipson. Feel free to email me or call rlipson@lionbrokerage.com. Feel free to reach out at the end. We'll take some questions. Have some time at the end for the question and answer. So please hang with us here and we'll get started. So I'm happy to shift over the presentation to Tawni. I'm going to make her the presenter. She's going to share her screen and away we go here.
Okay, here we go. And thank you, Rob. I sure do appreciate that introduction. And I am delighted to have all of you join us today. It's been an interesting day, has it not? And the week is only going to get better. We have history in the making. And what I'd like to do today is just discuss what is the heart of the US economy and what it is that we're trying to listen to so that we can respond. Today, we're going to cover a variety of topics, and I like to start and end with something optimistic, and that is that what's happening now, we're really sowing the seeds to the next recovery. I understand we got some bumpy news today, and we'll discuss it, but my hope is that we step back and we look at the economy as a whole. As Rob said previously, the disclaimer is this information is for educational purposes only. It is not intended to provide you with guidance in making financial decisions. So if you have questions, do me a favor, pop them into the chat box. And if you don't mind, I will answer them at the end. So our agenda today is pretty straightforward. We're going to talk about what's happening in the economy, and we're going to do it in a nutshell. And we're going to look at the numbers. So we're going to be looking at the economy according to the numbers. And these are the numbers that I had access to on Friday. I needed to get everything passed through and approved. So I understand that some of what we're presenting right now is not updated, but this gives you the power to turn around and interpret the data as it comes in. At the heart of the economy are the individuals who are living in households and operating businesses. It's people like you and me. And we're going to look at how we aggregate this information up. And we look at item number 3, and we're going to be looking at gross domestic product, the market value of all the final goods and services that the people who are supplying labor out of the households provide the businesses to produce the goods and services for people like me and you and around the globe. We'll take a close look at item number 4 here at the macroeconomic data and various indicators. Of course, we can't do anything on the macro front without talking about fiscal policy, monetary policy, and trade policy. We'll just provide some highlights and insights. And then, of course, we'll step back and we'll look at the deficits, the amount that government is spending above and beyond tax revenues, and we'll consider public debt. And then we will, as I promised, move from the doom and gloom of the present and the uncertainties that surround us, and we'll end with some hope and prosperity. And of course, we'll wrap up with questions and answers. And my hope is that you put your questions in the chat box. And unless there's something really important, if you don't mind, I'll wait until the end. I'm going to let Rob address any questions that may come up regarding the technology. So production. That is the production of goods and services using the resources that labor provides, the capital resources make possible, and entrepreneurial talent brings together along with our natural resources. When we take a step back and we look at the data from pre-1950, and we're not going all the way back to 1945 at the end of World War II, but we're going to look at what's happened, and we see that real GDP or real income per person has increased over time. So if we look at where we were in the 1950 period and we compare that to where we are now, we do see that overall humans have made progress. And this is something to keep in mind as we dig down and we look at some of what we're experiencing today. Even if we take the GDP per capita and we expand out and we look at some of the projections, even the current dip on Friday, according to the first quarter figures in 2020, we're still having trouble. But when we look at the 40+% decline that is likely in the second quarter, we're still okay. We're making progress over time in producing goods and services that turn around are consumed by people like you and me and businesses and other households. Unemployment, we've experienced a bumpy road, and the unfortunate thing is that we are experiencing some historic spikes in unemployment, but the economy itself appears resilient. And if you can look in the right-hand corner here, you'll see that the spike that we have, and I'm going to put this right here, is complemented by a drop. But as we all know, the unemployment benefits with the recent stimulus package are slated to go away on July 31st, which is just a few days from now. As we move on from unemployment and we look at, excuse me, I'm having trouble here, computer error. Let's take this highlighter off and all right, I am having a problem here. So I am going to move out of this. There we go. We looked at some of the claims that we're getting in unemployment benefits. And as we look at that, we see the same interesting things that are happening is that the unemployment is spiking and people are claiming more. But if these claims start to go away because people don't have anything to claim because the program isn't there, we see a drop in income, a drop in benefits, which will of course affect the production of goods and services as we move through the economy. Prices right now are interesting. Even when we go back to the 1950 or the 1960 era, we see that there's a lot of volatility in prices. And I'm only choosing to use the Consumer Price Index, which measures price changes in the consumer goods that are typically purchased or are brought into households in urban areas. We see that the volatility is there, and that on average since 1960s here forward, minus the 70s, this volatility has been pretty much inflation, but as long as wages and salaries and the increases in them keep up with prices or move above them, people are okay, and they're able to consume what it is that they take in with the income they earn. But when we step back and we look at the growth that we've seen in the US economy as measured by that GDP per person, we see on average we've increased the income that we've earned. We see that we, on average, are employed with moderate unemployment rates, and prices are keeping pace, and they're moderate so that we can experience that growth in our economy. What's happening now has happened before, and when you look at the shaded areas in these different graphs, you'll see that these are recessions. So the last recession, of course, we have is the recession of 2008. We see that it's shaded right before the 2010 period. What I'd like for you to note is that from the end of the Great Recession of 2008, we've had the longest period of expansion in US history, 128 quarters of growth and prosperity. So what does this mean to all of us? Well, even when we look at the producers and the producers charge the prices that the consumers end up paying, we see that the producers are experiencing some interesting situations. But again, they prove resilient. Like consumers, the producers are facing price fluctuations, but the producers look at the prices from all phases of the production cycle, from natural resources to intermediate goods to the goods that they produce and are ready to push out to the final consumers. So it's a nice thing to look at the producer price index because you can get a pulse of what's coming down the pike for the consumers. So now the stock markets we're all interested in for obvious reasons. And in the stock markets, we see some interesting things happening because even with the dip in the recent market, we have some things that are going on, but the stock market itself is not reflecting, at least at this point, some of the craziness that all of us are seeing and feeling and experiencing, at least emotionally. And on average, we see that there's growth in the stock market and more people are participating in the stock market. If it's not individually through their own personal portfolios, they are through their pensions and the pensions that are tied in the stock market as well as other assets. Now, if you haven't used the finance.yahoo.com, it's an interesting tool that provides you with a lot of flexibility to get a broad view of some of the things that are going on, and it's free. It's always good to have a financial advisor help you understand what you're seeing, but most importantly is to have that financial advisor help you understand what's going on with respect to your portfolio and some of the challenges that you face. But the stock market itself is experiencing volatility, but we have to look at the long run growth here. And markets do very well at pricing some of the disturbances. When we add in to the Dow Jones Industrial Average, which represents our blue chips, and we bring in that Standards & Poor 500, we see that they move pretty much in sync. And then when we bring in that NASDAQ, which is relatively new across the three, we see that similar patterns emerge. But there is some interesting things that are going on in the NASDAQ with these new companies and relatively high risk. The high risk is reflecting some of the relatively high returns, or at least higher returns than the S&P 500. So if we back up, and the point of our time together today is we want to connect some of these dots. So what is gross domestic product, and what does it have to do with employment, unemployment, and how can government policies move the dial, or can they? Um, you know, these prices mean something, but prices mean something to consumers because they represent what they have to pay in order to bring goods and services into their households. But price changes are also going to impact interest rates. And interest rates, at least nominal interest rates, will move in tandem with the price changes. So if price goes up, nominal rates will go up. But we have monetary policy now that's impacting the interest rates that are being realized by both borrowers and lenders out there. And then we have wages, and wages that are being earned, but these wages right now that are being paid aren't moving in tandem with the actions and the interactions of buyers and sellers. They're being influenced by some of these policies, the fiscal, the monetary, and the trade policies. So to bring all of that together provides us with an interesting story. And then once we bring in the unemployment benefits of recent through the discretionary policy decisions of Congress, we have some interesting times in front of us. And how are we going to incorporate that into our portfolios and into our lives? Many of us are paying mortgages. We're looking at housing prices, some of the things that are happening with rent. And then we have proposed policy discussions that are swirling around us. It's a lot to consume. So we want to bring it back to what it means to the person who's sitting in front of the computer that's interacting in this webinar today, that could possibly be raising families, owning businesses, managing others' portfolios, providing advice to parents who are aging or getting children ready, students ready to go to college. The connections are important. And the connections start with the humans. And what do we offer in the market? Economists call labor. That labor, the skill, the talents that we bring to the market, the employers turn around and use, employers like Walmart, employers like some of the others, 7-Eleven. It's important to make these connections, but it's not just about the labor that matters. It's also the capital, the buildings, the equipment. Even though people are unemployed or employed, that capital, the physical capital, not the financial capital, but the physical capital, the tangible things that you can touch, it's not going to go anywhere. And it's not influenced by where the economy is on its business cycle. You have a fixed amount of buildings and machines and equipment out there, but the business's interest and adding more machines and adding more capital gives us indication about where we are today producing our goods and services and where we're going to be in the future. So it's important to look at inventories, investments in fixed capital, new housing starts. So we'll bring all of this together at the end. Now, other and econ jargon, what it refers to is like the entrepreneurial talent and the natural resources. Because we don't have the time, I'm going to set those two topics along the sideline. I know that there's some interest in oil. We can talk about it at the end if you'd like to. But right now, what I'd like to do is connect the labor that's out there and how it has to do with unemployment, or what it has to do with unemployment too, with the capital, and that's our fixed assets, our buildings, our equipment, and then we have the other, the entrepreneurial and the natural resources, and connected to the value of the final goods and services that are being produced in our economy at any given time. As we know, they're measured in quarters, and quarters are brought together, and we've got annualized figures. But basically what GDP, or gross domestic product, is it is the market value of final goods and services, and these are final, they're not intermediate or natural or beginning of the production change resources, but it's goods and services that are produced in a country in one period. We just heard from the Atlanta Federal Reserve Bank that GDP figures for the second quarter have slid. So what that's telling us is that the market value of the final goods and services that were produced in the second quarter, that there's been a drop. The GDP is the primary measure of economic health in any economy. It gives you a broad view of what's happening across those industries. And we have various goods and services. In the previous slide, we saw images of Costco, 7-Eleven, and some of the other places. But this GDP figure is used to provide us with placement on our business cycle. And a business cycle basically tracks the ups and downs of total economic activity throughout time. As many of us know, a recession signals that we've minimally had 2 quarters of negative GDP growth, which is officially where we are right now after our second quarter figures that were released today. And these negative changes, along with negative changes in GDP growth, along with some other macroeconomic indicators, tell us more about what's happening in the economy, from production to the consumption to the employment, and back to production, consumption, employment, investment that tells us something about our future. Okay, I now know, I think what we have here is a go-to. So I'm just not going to be able to use our go-to pen, which I'm not used to not using it. Okay, okay, I apologize. So we've got rid of the pen and we're trying to move forward and it's not permitting me to do it. Oh, there we go. I'm not sure, it's the time lag, I believe. I apologize, everyone. So what you hear first in the news as released are the nominal figures. That's the current figures in GDP. And really what you're doing is we are just taking the prices that were paid and we're multiplying it by the quantities that were consumed or sold. You can use quantity is represented by Y, but it also can be represented by Q, and you'll see this in some of the reports that are out there. And so nominal GDP is just taking the current price and you're multiplying it by the quantities consumed or purchased. And to understand the differences between nominal and real, I try to help people imagine when they go through a marketplace. If you're at Costco and you buy so many items, you just multiply the items by the prices that you pay. You walk out of Costco after you've made a payment. That is nominal GDP. You're taking the current prices, multiplying it by the quantities consumed. This is tabulated across all reporting businesses, and it's fed into a system, and it's analyzed, and we get the nominal GDP figures reported to us. Now, when we move to real GDP, what we're doing is we're taking constant prices, and we're looking at a year in which we're just going to take the prices and we're going to value the items that were consumed and sold in, let's say, 2020 first quarter, and we're using, in this instance, we're using the 2012 prices. I'm not going to use my pen in the go-to that we have right now because of the lag. But if you look on the vertical axis here to the left underneath Fred, the logo there, you'll see that we're looking at the billions of change 2012 dollars. So when we value real GDP, the quantities are what have been sold during the first quarter, but we're using those 2012 prices. Well, why do economists do this, and why are they interested in real GDP and not nominal? It's because when we compare real GDP across time, we're looking at changes in quantities bought and sold, and we're not bringing in to account or into the picture the changes in the prices. And as we all know, changes in prices can impact a lot of different things. So we're removing that price influence or factor out of it. So when you're looking at different reports, it's really important to look at the real figures. And if you're given the gross figures, you can always take one of the price deflators. You can use the GDP price deflator, the consumer price index, or the producer price index, and bring it to its real value, because that will tell you something about what's happening in the area after you've taken into account price differences. And when we move into housing prices or we move into rental costs, this is really important. As we all know, a $5,000 a month apartment in New York is going to rent a different space than one in St. Louis, Missouri, or in Milwaukee, Wisconsin, or in Marquette, Michigan, in the Upper Peninsula of Michigan. And so you want to know something about these price disparities, because we're interested more in the square footage of what is available in these different cities that were mentioned versus the changes in the prices. And we want to compare what your income will buy or what the business can produce given these price variances. So always make it real when you're looking at these different figures, because the price changes can influence a lot. So going back to the just simple math of it all, GDP, whether it's nominal or real, and you can use Y or Q to represent quantity, is that you just take the price and you multiply it by the quantities purchased in a given year. And when you're talking about nominal, you're using those current prices. When you're talking about real, you're using the constant prices. Before making any decisions, whether you're an individual in a household or a person operating a business, it's best to make decisions based on those real figures. And when we're looking at the economy, we want to look at real GDP. We want to look at the real value of gross domestic product and use that as a proxy for real income. So what's happened at the end of the first quarter in 2020? We see that we had a dip of about 5% in real GDP. Now this is moving away from the actual figures of the previous quarter. And when we looked at the end of quarter, or at the end of 2019, we saw that we had an increase of about 2%. And that was complemented in the first quarter of 2020 by a slide of 5%. Nobody could have predicted the outcome of the pandemic and the shutdown and the impact that it's had across households and businesses around the world, not just in the United States. So when you go in, and these figures won't be released just yet because they're very much in the preliminary stages, and I'm sure many of you are aware that the GDP figures, they're released one month, they're revised the next month, and then they're finalized in the third month. And at the end of the quarter, what you have is what you have, and then you move on to the next quarter. And we just got the first release of the Q2 figures. So let's go back and let's look at the real GDP figures for the Q1 in 2020. And when you break it up into the 4 segments or sectors of the economy, you see that individuals who are living in households who are primarily responsible for their personal consumption, that they are the ones that contribute the most to real GDP. That is the largest chunk of activity in the US economy. About 70% of all spending stems from households that are made up of people like you and me, people in our neighborhoods, across the region, states, and around the United States. When we move on to gross private domestic investment, now this is the investment in the physical capital that I mentioned earlier, the equipment, the computers that are used for business purposes, the buildings and such. we see that businesses, private businesses, are responsible for about 18% of real GDP. And then when we move down to government, we see that it is responsible for 17%, which is really interesting because the public investment is almost matching the private investment. The difference is at the end of the day, the government investment and consumption is not driven by people who have to use income that they've earned in the markets. In fact, they're making these decisions in the government space based many times on policies of present and policies of past, that discretionary and non-discretionary policy piece that I mentioned earlier, if we're talking about federal government. And then when we move to net exports, and this is just exports less imports, we see that about 4% is brought into the United States through imports. These are goods and services that are produced in other countries. And that's about 4% less that we bring in. We're actually exporting out. This is not necessarily a bad thing that we have a trade deficit, because what's happening here is that we're consuming goods and services that are priced lower from other countries. But the bottom line is when we look across GDP, gross domestic product, we see that it has those four components. The private sector is made up of consumers and households and businesses that invest. When we bring those two together, we have about 80% of the economy. Understanding that we do bring in exports, imports, and we also export, we have to take away about 4% of that private spending in households and businesses, and we account for a trade deficit. But then we move over to the public sector, and we see that government is responsible for about 17% of all spending across the United States. So putting these trillions into perspectives, this is something that people in different audiences just simply love. So if we look at our real GDP and we look at what the amount is, we see that we have about $19 trillion worth of goods and services being produced in the United States, according to the first quarter figures. That's a really, really big number, according to Webster's dictionary. And when you step back and you think about it, well, a trillion's only 1,000 billion. But dig down and think about the magnificent impact of what we're doing in the United States, because when we think about what a million is, we look back, 1 million seconds ago took place 12 days ago. When we think about a billion, what happened 1 billion seconds ago took place 32 years ago. And then when we move up to a trillion, that's 32,000 years ago. So that 19 trillion is a significant number. And when we look at where we are today and we compare it to where we were in 1900, and trust me, if you stay with me until the end, I'm going to show you, I'm even going to go back to 1790, what's happening across time in the United States and in a lot of other countries is that humans on average are flourishing. And we're doing some incredible things. The United States historically has done more in 250 years than any other country. And when we step back and we look and we compare what's happening in the United States, and we drill down and we look at what's happening within these states, it's a pretty impressive picture that we can paint. When you look down here at Canada, look at Texas, if you would please. You see that the Texan economy is equal to, or a little bit bigger, marginally bigger than the entire Canadian economy. Hop on over to California, and you'll see that the California economy produces more than the United Kingdom. And I'm sure that, let's see, many of you I've been told are from Wisconsin. And Wisconsin's economy is about the size of Singapore's economy, which is interesting to draw those parallels. So where does this take us? Well, recognizing that personal consumption is such an important part of real GDP, it's important to figure out, well, what's happening there? Well, the lion's share of total output that's produced moves into the households of people living across the United States, and therefore producers and investors closely monitor what's happening there. Well, we all know that what is supplied by the producers, the businesses, and the employers is driven by demand. Hence, the reason that so many pay attention to those personal consumption figures. I'll get into some of the macroeconomic indicators that drill down and look at what happened during the first quarter. But overall, even if we went back to the 1790 period or even 1900, we'll see that the amount of goods and services consumed by individuals living in households have risen along in tandem with the rises in real GDP per person, which is a proxy for real income per person. When we add in gross private domestic investment, we see that it remains steady. And as I previously mentioned, it's about 18% of the economy. If you're interested in the actual figures, you can just hop up and look at the real gross private domestic investment figure. And it's about 3 trillion, which compares to the 13 trillion coming out of households. Government, as we move forward here, we see that government spending is about 17%. Now, government spending, as I said before, is different from private investment as well as consumption, because we're using tax dollars and bonds to purchase federal, state, and local goods and services, and we're making investments in investments. And so what's happening is the income that is earned by individuals living in households and people operating businesses is that their income is being transferred to government, and government is turning around and spending it on goods and services. And because of deficit spending and public debt, government can spend more than it brings in taxes. So we have to bring in that net export piece because it captures what's happening in the international sector of our economy. And we understand that businesses around the United States, they do produce for US citizens, but they also produce for many people around the world. This is going to be important when we talk about trade policy and the tensions that are continuing to build between the United States and China. Imports are those goods and services that have been produced elsewhere in places like China, but also in South America and Mexico and North America and Canada, and the list goes on. Net exports have been negative since the 1960s, and we hear a lot in current media cycles about the political tensions that says that when we're talking about the negative impact, and we're trying to put it around the people, let's say in China, we're actually stopping goods and services from getting to the people, especially those people living in low income households that may benefit from the lower prices. So as we move forward, we've got a big picture of what's happening in the economy, and I stacked the different pieces here in the previous slide with the net exports just to give you a good visual on how important, when you look at the blue, the personal consumption out of households is in our economic engine. This is an important chamber of the US economy and its heart. Then we move, and the second most important is down to that private domestic investment. But then when we consider government, we see that government's role is pretty important. And then we have these negative exports. If we took those away, we would lose out in producing for other countries, but we'd also lose out in importing. So we're avoiding double counting by looking at the net exports in the way that we do. This is the interesting slide, and this is the econ geek in me that all of you, I think, are going to benefit from. is that when we look at government spending, and that's in the shaded green area, and we layer it over the gross private domestic investment spending, we see some interesting patterns there, and that is that gross private domestic investment is being overshadowed at times by the government consumption and its investment, which is just an interesting observation. But this is something that I observed from 2002 forward. I'll let all of you decide what that means in terms of your portfolios and how to understand it. So moving back, now that we understand the different chambers of the heart, the US economy, and that they are personal consumption, which is the largest chamber. We have private investment, second largest, but just marginally larger than that government spending or the public sector. And then we have the international sector that we're always mindful of. As referenced earlier, we just left the longest expansion in US history, 128 quarters from the previous trough, which was in our Great Recession. The Great Recession of 2008 ran from December of 2007 to June of 2009, and then we entered our next expansion. 128 quarters, it's pretty impressive. And as we move forward, we're going to see that we're in a downslide, but we have a pretty solid footing that we've jumped, we're falling, but we've jumped from a place where when you step back and you look at the things that we've talked about, there are reasons to just have faith that we're going to meet the challenges of the present and deal with the uncertainties that are swirling around us. If you're interested in GDP, you know that we have other indicators that are out there that are of interest. Now, the US Department of Commerce will be updating these infographics and these statistics so that we can understand them better from the private investor's perspective. I recommend hopping on and looking at them to give you an idea of what we have. You'll get the first quarter, or excuse me, the GDP statistics. And as I previously mentioned and we discussed, is that during the first quarter of 2020, we see a slide in the US economy and we have a negative growth rate of 5%. But, you know, when we look at the changes, we see that that's coming on the back of a 2.1% increase from the fourth quarter of 2019. So it's hard not to get caught up in the moment. But I think if we train ourselves and we step back and we look at the health of the 128 quarters of expansion, we can just at least take a deep breath and say, I don't know what's in front of us, but we have been here, different circumstances, and we've navigated through the uncertainties of past, most recently that Great Recession of 2008. Consumption is so important to this economy. It's the largest chamber of our economic heart. We did feel a slide of almost 6% in retail trade. All of us visually can see the businesses that are closing, and we see the sales 70% off. These are unheard of at this time of year. Usually that's something you see in January. But again, that comes on the back of high growth. Rental vacancy rates, they're up, but they were up when we were heading into the situation in the first quarter of 2020. We see home ownership rates are just now holding their own. There's some interesting things that we're hearing about from that sector of the economy. We're looking at the, why is this going through this? Oh, now we're moving into the business side of it. We just captured what's happening on the consumption side with retail sales, rentals, and home ownership. When we move over to the production side, we see manufacturing, mining, wholesale trade, and selective service industries. Big drop, about 40%. New residential construction, surprisingly, jumped up in June of 2020. And people are expecting that to slow considerably as these new numbers come out and some of the realities of the present become more obvious to all of us. And then we see the manufacturing shipments. There was a big slip in April, which is when most places were shut down. Then we see as economies open up, the regional communities, we see a positive increase. So what about the GDP figures, and how do those first quarter 2020 figures compare with the second quarter? I recommend all of you head into the Federal Reserve Bank of Atlanta if you're interested in keeping track of these, because this kind of breaks down what is happening or happened, excuse me, in the first quarter. And we can break down the private investment piece a little bit more and see where the slide was the greatest in that first quarter. And you can look directly to your right and look at the dark blue area, and that shows you that big drop in consumer spending, which isn't hard to imagine simply because of the lockdowns, and people weren't out and about and doing the things that they normally do. Let's hop over to the real GDP in quarter two. We have that big slide. So if we look to the extreme left here, and we see that we have the slide that's coming about, and that's, remember, through the entire quarter of 2020, quarter one, it was 5%. But this can track it according to the Federal Reserve Bank of Atlanta by week. And when we look across the entire period from April 30th to July 29th, we see what it is that has happened, with the biggest hit being taken by the consumers living in households. Then we move into that non-residential fixed investment. That's anything but the new housing starts and such. So these are some interesting statistics because one person's problem is another person's opportunity, and we can figure out what was happening and try to get a feel for how to respond. What's interesting here is you go into GDP Now, another tracker that is provided by this Federal Reserve Bank of Atlanta, and you can get a better sense of what the blue chip companies are thinking. The Atlanta Fed does some interesting work with businesses across the United States, and it specializes in interviewing and keeping track of what the blue chip companies that are represented in the Dow Jones Industrial Average and others that are not, what they're thinking, what they're predicting. Are they optimistic about the future? How do they see things shaking out in personal consumption and investment? So this is a good forecast tool to use to get a better sense of what's happening according to those blue chip companies. And then the coronavirus cases. As we move into that, I was just on a webinar today, and we're trying to get our head around what COVID-19 means to us and how we're going to respond. The interesting thing about the coronavirus is that it's impacting the world. It's unlike a natural disaster, where a natural disaster is very localized. And so systems around the area impacted natural disaster can respond. So Katrina was something, Hurricane Katrina and like disasters were mentioned. And even in the United States, you knew you were going through the disaster, you could localize it, and we could move goods and services into that area. COVID provides us with an interesting case, and we're on lockdowns. It's universal. And so when we're looking at trade-offs, if we can't get supplies to where they're best needed, because they're needed everywhere. It's really hard to calculate where it is that your resources are best used when there's uncertainty that's penetrating all these different systems. You know, some of our biggest friends in the net export sector, they are having, you know, similar problems. They're trying to feed and provide food and shelter for their own people, and to bring it into the international arena to bring to the United States is problematic for them too. So it's an interesting phenomenon, and it's one that we haven't experienced since the pandemic of 1918 of this magnitude. We've had other pandemics and virus cases. It's just this one stands out in world history. So we've got the economic problems that we've described of recent with the GDP figures. We've drilled down, we've looked at consumption, we looked at investment, we looked at government, we've considered net exports, stimulus spending. It's set to expire when we look at the unemployment insurance benefits as they relate to the recent COVID or corona's cases, and that happens on July 31st. Who knows what's going to happen in a Congress that is riddled with tensions from bottom to top, from top to bottom. But we do see that these unemployment benefits and the assistance that it's provided is significant. The all other that you see here in the lightly shaded area is a part of packages that were decided long past, and they've become a regular part of our systems. They're not related just to the pandemic, but that's going to go away. So it's going to be interesting if things unfold as they should. They stated on July 31st, think about the impact on consumption, investment, and some of the other statistics. Turning to monetary policy, we heard from Powell today that interest rates are going to remain as is, that the Fed is going to continue to monitor the situation. It's prepared to pull out all guns. They're monetizing the deficit and the debt, which means that the Fed is purchasing Treasury securities and such. It's interesting, when we go back, we took a look at some of the monetary policy moves of the 2008 financial crisis. And of course, history has 20/20 hindsight, but there were some interesting moves that were made there. Who knows what the Fed is going to do? But the Fed is actually taking a systematic look at what they've done in the past, and they're going to be setting an eye more on their long-term or long-run policies. They may have to step aside given the current situation, but monitor the Federal Reserve Bank's website to keep updated. Trade policy, my friends, we all know what's going on there. The tensions between China and the US continue to escalate. There's a lot of rhetoric that's happening. Security concerns, we're seeing that some of the security issues are being tried in US courts, and that continues to play itself out in the economy. So as we move forward, we know that we can have expansionary fiscal policies and monetary policies to help address the issues in a sluggish economy. We're marked by a recession, possibly a depression. What's the difference between a recession and a depression? A recession is when your neighbor loses his or her job. A depression is when you lose your job, and that's Franklin D. Roosevelt, I believe. So, but what happens is that we start spending more than we take in. As we all know, our deficit, federal deficit, is ballooning, and our federal debt has reached a historic high. What's disturbing about this is that the Fed is buying more or taking possession of more of the federal debt, which just means that there's electronic bookkeeping taking place, and they're sitting at their systems and they're crediting and debiting based on this internal relationship between the Fed and the government, and who knows who's monitoring it other than the Fed? I'm not sure. I know that there was a slight drop in some interesting things that happened in gold and silver. It's not surprising that when things start getting rocky, especially in the asset markets, or people believe that they're rocky, people just move into gold. Historically, some interesting things have been going on in some of the cryptocurrency areas. I'm not going to get into that, but keep an eye on it because it is interesting. And what happens in the cryptocurrency market actually makes the federal monetary policy and the federal stimulus policies of the government less effective. So I promised to leave you with a story of hope and prosperity, and I will. Take a look at this, my friends. Look at US real GDP per capita. Go and visit where we were in 1790. We were at the bottom, at least by historic comparison, and we navigated through some of the interesting times. If you hop over and you look at the 1918, or where 1918 should be, between the 1911 mark and 1922, you'll see that we did experience a dip in the economy. But guess what? The 1918 pandemic, it set the stage for the Roaring '20s. Yes, the Roaring '20s, we entered into the Great Depression after that. There are various competing theories about it. That is for another webinar if you're interested. The Dow Jones Industrial Average. Yes, we've experienced drops, but when you compare it to where we were when it first opened in 1885 and the number of people who are involved, we'll see over time that there's been positive activity. Same holds true for the S&P 500, which has just been around since 1957. And then when we move to the NASDAQ, which is newer and younger than the other two indexes that we talked about, you see the same holds true there. So when we wrap this up, we know that the US economy can be a complicated thing, but the heart itself is still beating. It's going through some trouble right now when we look at consumption, investment, government spending, and net exports. Household and business activity, they're taking some hits. But when we look at GDP close up and we look at it and compare it today to where we've been in the past, the macroeconomic data and indicators, that they're powerful information. To have this data gives you the knowledge you can use to make some strategic choices based on your positions in life. And then the fiscal, monetary, and trade policy highlights are present. They impact us, and we'll have to make decisions based on the policy decisions of others in which we have no control, but it's important to be mindful of what's happening there. The deficits in the public debt, when we look at public debt, we see that right now we hold more debt than the entire economy produces. We're at over 100%. This is reason to kind of pause and think about all of the spending that's going on, and are we sacrificing some of future spending, trying to get through some of the past spending, and a lot of that spending did not take place just because of the pandemic. But the bottom line is we get to item number 6 there. Yep, it seems like doom and gloom right now, but there's reason to hope that we are going to rise up from the ashes and that we'll make good decisions, and that 10, 20 years from now, we'll be telling stories about how we lived through the pandemic. And at one point, we just saw doom and gloom, but we ended up with hope and prosperity. And that is a wrap, my friends. Do we have any questions? Okay, I am going to shoot this over to our friend. Good to go. Video is good. Thank you. Oh, I have a teacher in here. Oh, Dre. Dre, hey, how's it going? Excellent comparison, Carlos. Thank you. I don't think, okay, is the US currency going to retain the value with the deficit growing? That is a concern. So with the currency situations and with the tensions, some interesting things can happen with our currency, and some of our currencies actually around the world. We have the floating, we have the fixed, and so it's really, really hard to tell what's going to happen on that currency front. And So just be mindful of that. That actually is a webinar in and of itself. So let me know. And all of you who are out there, please stay in touch. I'm interested and available to do webinars like this in the future. And this is my first one for this company. So there's always room for improvement. Let me know how. I like to be interactive so I can actually get some responses from you. I'm good. I'm very happy that some of this made you feel better, but please, 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 everyone who's out there, do me the favor of touching base with our friends at Line Brokerage, and you will get some good advice there. And you can follow up. You can follow me at tawni.org. You can reach me by LinkedIn. You can reach me at the university at Lindenwood, tawni.ferrarini@gmail. Let's see, what else can we do? I think I'm not getting in, what is it, Joseph? I'm not getting into the political discussion right now, my friend. Nice try, though. Okay, this may be a wrap. Is there anyone? I'm not getting the full questions. Okay, let's see. All right, I think it may be a wrap. What do you think? I wish I could hear and see all of you. Okay.
Thank you so much, Tawni. If anyone has any additional questions, certainly you can always email them, and we're happy to pass them on as well. And we're very thankful for you to take the time and do the presentation for us. We hope to have you back in the future, so certainly we will be in touch. Everyone, thank you for joining us here tonight. Please note the recording will be on our website within a few days, so you can certainly review that and go over it and recap the information provided if you missed some of the items she discussed. But thank you so much. I'm sure everyone gained a lot of insight here. I know I did. Thank you. Everyone have a great night, and thank you very much, Tawni.
All right, you guys take care, and it's a joy to be with you, and be healthy. Talk to you soon. Bye-bye.
Take care. Bye.